Hello, everyone, and welcome to the second episode of the Tokenizer by Crypto Valley Association. Today, we have the honor of having with us Kyle, who is the founder of Security Token Market, which is a startup that is focused on blockchain and on the DeFi world. So, Kyle, nice to meet you and having today with us.
Thank you so much for having me on the show. I'm excited to dig into the blockchain industry a little bit more. I think you gave me a great intro. I'm Kyle Sonlin, and we launched Security Token Market 3 or 4 years ago in tracking the security token space, which is taking real world assets and applying blockchain technology to improve that process. And a lot of my expertise does kind of merge with a lot of the fun terms like DeFi and crypto and a lot of these different things that you may have heard. So we'll definitely have to get into a little bit of everything on the show.
Cool. So Kyle, just to start off with the interview, I would like to ask you, what's DeFi for those of the in the audience that they don't know anything about this new innovation and this new way of doing finance that we are reading in the news every day?
Yeah, so DeFi is this idea of taking a lot of the traditional financial processes that usually would be relied upon by banks and financial service providers. They would need to use very manual processes to identify who exactly is investing in different projects, who exactly is transferring their assets from place to place. And so instead of relying on those banks and those third-party middlemen, the idea is that we can use code to automate that process much more effectively. So by automating it, you can now reduce the costs and you can increase the efficiencies of transfer of things, whether you're buying or selling or you need a loan. And lending is a really big example of that. And so you can do a lot of these things permissionlessly, where you don't need to work with a bank that will take their fees and handhold you through it. You can instead use an application that's been built out that leverages blockchain and smart contracts to do so.
Okay, so we could define it as the bank 3.0, no? Like the new digital bank that has emerged with all the blockchain technology and now is giving access to more people, no, and more freedom to investors and buyers and sellers, no, in a way.
I think that's a good way to look at it. It's kind of like unbundling banks, right? Where they would traditionally do all of these different services because they had all the licenses that they were needed. And now we just have the different applications, right? If you need to get a collateralized loan, you can do that very effectively through using Compound or AV or one of these different protocols, as well as if you're trying to do some other kind of technology, through issuance of an actual asset, you could use an issuance platform to do that and actually launch your own stocks and investment products just like you would with the traditional market, except you're now able to do that at a much cheaper and much more effective global opportunity as well. So it's encompassing all of the financial sector and how that grows and develops.
Yeah, it's amazing. It's a really transformation of the whole industry. So yeah, I think for the future it's gonna be massive, the transformation there, and it's gonna be also fun to see people interacting in this new system, because we've been used to interact with banks for everything, loans, trading. So now having this freedom to go to a market and list our own products is something that is completely new. And in that way, I want to ask you, Kyle, from your experience, what are the risks you see here? Because there's no one regulating or controlling who list or what people list in this market.
I do think it's a very nuanced answer because it does depend on the different application, right? So this might make sense. Different services that you need might have different levels of requirements. So one example of one way to mitigate risk, especially on the asset side. So I work primarily in security tokens, which, as I mentioned, is this idea of taking private company ownership equities, it's taking real estate, it's taking debt products, and it's putting that information and putting that asset on chain so that we can trade around the world simultaneously, seamlessly from anybody that needs access or wants to invest in these different products or in these companies or whatever. And this is an industry that's very regulated for good reason. We need to make sure that we know who the investors are, that there's no, money laundering, or there's no financial crimes that are occurring. Also, if you're talking about legal ownership in an asset, we need to know exactly what the company is. We need to know exactly who the investor is so that we can manage these things. And so with the security token space, it is highly regulated, and we'd have to treat these things the same way that we would treat a traditional financial asset, which means that you need to do the identification process. Especially, you also might need to be an accredited investor, which is a certain level of income to be able to be allowed to invest here in the US as opposed to internationally. It's more of it's a little bit varied in terms of the qualifications that you might need. But with that information, we can track that through the blockchain. And as long as you are who you say you are, and you are, by the definition set by your country, allowed to invest in this opportunity, you can do that seamlessly. So you might not need that same level of third-party support, but you still need to take those steps to ensure that you're doing it properly and legally, which is super, super important. And a great way that, a reason why this is beginning to see more mainstream adoption is because we've taken, along with me and my firm, as well as a lot of the other companies in the space, have taken a lot of emphasis on making sure that you follow all of the existing regulations. And so as long as we follow the existing regulations and then build applications on top of it that can open what we've already set up as the rules to make an even bigger opportunity, that's kind of where we try to play in that sandbox. And so because of that, you do drastically mitigate some of the risk associated. That being said, with some of these other DeFi applications, especially ones that tend to use cryptocurrencies as their main form of investment. So if you're talking about collateralized lending, for example, where you could stake your 1 Bitcoin that you own and get cash back now that you could then spend and then pay back the loan over time or something like that. Those do have risks associated because there is not that same level of standard that has been applied, which is either a risk or a reward, because some people like the permissionless aspect of it. Some people like the idea that it is a little bit more anonymous, but the reality is that that doesn't work in some different sectors, right? When we're talking about real world assets, investment products, that just doesn't work. So it kind of depends on the level of risk and reward that you as a user or an investor are looking for and looking to get out of, and definitely making sure that you're staying legal, staying compliant, and none of this is legal advice for sure. But making sure that you're doing it compliantly is important.
Yeah, absolutely. I think being with the right company or with the right advisor in this space is crucial in this moment that we are living, because we are in the beginning of the transition or in the living the creation of this new system. So it's crucial to have these advisor or companies like yours that can follow you or guide you through the journey of the tokenization or the DeFi. And another question I received many times is, okay, I understand that you need to comply with all the regulation and everything to create the token, but then I'm free to lease the token in this DeFi protocol. So nobody does a due diligence on the company or on the real asset or whatever it is. So how can you mitigate risk there? Because you can list the share of a company that might go in bankruptcy because the business model is not good. So how do you see that, and what can investors do in order to mitigate these risks?
So with real world assets, it definitely gets complicated because oftentimes a lot of these issuers will work with an issuance platform, which is a company that does have some level of financial licenses to allow them to do a lot of the diligence that's required for these offerings. And they will also have to file their, a lot of internal incorporation documents and many other things that do hold that level of that standard of what you're providing to some degree. Obviously, startup businesses that you invest in, there's a lot of risk there. Even in the traditional markets, 90+% of tech companies don't end up working out. So there is a high level of risk in terms of early stage businesses, which is why a lot of the target has been focused around assets that are less risky. For example, real estate is a great example. Real estate is an asset class that has been super successful over the centuries, and it also can pay out a dividend from renting the property. So you could sell fractionalized shares of a property and then the investor would not only receive the appreciation in the property value over time, but they also might get a dividend or something along those lines from the rental payments that the individual tenant is paying. And so an asset like that is going to be something that does have less risk from the bankruptcy perspective, but it may also have a little bit of less of an upside on, if you ended up investing in Facebook, you might have made a ton of money, but for every one Facebook, there's 1,000 that don't necessarily work out. So there's certainly, I think, risk there as an investor, and you need to keep those things in mind. And then again, mitigating the risk from a fraud perspective is much easier because of the fact that we do require, and all these issuance platforms require a level of compliance there, that you're not just listing something that's a shell company doing nothing. You are onboarding your investors properly. They do know the proper risks that are associated. And then, it kind of does go from there. So there's certainly plenty of risk. You need to do your own research when investing in these things. But, hopefully by following a lot of the regulations and ensuring that the companies are following those regulations from their local jurisdictions, it's a strong way to help uphold that level of standard.
Yeah. I mean, I think it's really important to make everyone aware that the product implies risk, but as you said, if you go with the right person, then you mitigate this kind of risk. And another question I have, you mentioned before that you can lend against Bitcoin, for instance, right now. So do you see in the future lending against, for instance, a token representing the ownership of a real estate asset or not?
I think that would be fantastic. I mean, think about it today, right? If you own, whether it's real estate, that's a property that you own separately, maybe it's your primary residence, or even if it's Amazon stock that you own. Like if somebody owns something like that, they're thinking long term. They own this property or this asset for the next 20 or 30 years, and they're using that for their retirement or for their long-term savings. How cool is it that they could actually stake that in a protocol and get cash that they can spend now, and then that's appreciating in value, and they just need to pay back whatever they took out in a loan that doesn't increase in value. So they don't need to sell the Amazon stock, or they don't need to sell the real estate property, but they can get some liquidity now to be able to spend on the things that they want while still keeping that investment locked. And then they would just have to pay back that loan over time. I think it's a really interesting opportunity to get leverage as an investor. It's also an opportunity for people to get liquidity when they need it, especially whether it's from a loan perspective or from a collateral, fractionalization perspective. Being able to sell a fraction of a property that you own versus needing to sell the entire thing is something that's also very fascinating. I totally see it happening. The one problem, especially on the lending front, is that it does require licenses when you're talking about real world assets. And so in DeFi, in the decentralized finance, they've been able to get away with it with crypto because crypto is still they haven't fully figured out exactly what asset class crypto is. And so because of that, these protocols have been able to take advantage of that to offer these lending protocols. And so once you start talking about real legal financial assets that just so happen to be traded on the blockchain. Again, don't forget, these things are blockchain assets for sure, but they're really just financial instruments. They follow all of the exact laws set by the SEC or the wherever jurisdiction the assets based out of, whether it's Europe or Asia or South America. You have to follow those laws. So it's definitely it's an interesting perspective, and it's one that I would love to continue to see grow, but we just haven't quite exactly seen that launched yet. For now, it's strictly crypto, but the application as you're going to is tremendous, and it's just so large. It's exciting.
Yeah, for me, the lending part for real estate is necessary because if you hold participation in a building or in a company that owns real estate assets, and now you don't have liquidity, but through DeFi you can get this extra liquidity you mentioned. That's amazing, because then you can use it to buy another property or to invest in another thing. And I think an important key aspect here is that the difference between the real world, the traditional world, and DeFi in this sense is that the collateral, the guarantee is already on the hands of the lender. So if the borrower defaults, you can always have this smart contract that triggers, and then the lender has the ownership through the token that is already in staking. So I think that is also a revolution, no?
That absolutely, absolutely. I think that the closest example that we've seen is this company called Reino, Reinno, and they're offering a collateralized loan on a property that you make on an investment, but specifically for the lockup period. So with these assets, when you're investing in real estate or investing in any kind of security, you have to have a 12-month lockup period as a US investor before you're actually able to be given that asset and then be able to trade that thing. And that 12 months kind of stinks because you've invested, but you're illiquid for that period. And what the innovative model that Reino's come up with is they actually will immediately offer you a significant portion of your initial investment in a collateralized loan backed by the investment that you just made in their property. So you can essentially invest, and then during that 12-month period of lockup, you essentially get 75% of your cash back or something like that to be able to then use how you'd like. And then you just would repay that at the end of that period to get your asset and then be able to do what you want with it. And so there's some really interesting mechanisms like that that are building and being developed by platforms all around the world. And it's only going to grow. And as you said, it's being able to take your investment and then being able to scale that up and be able to do something else with the cash, essentially taking leverage on your position for real world assets, is something that we've really never seen before and could exponentially grow the markets as savvy asset managers are able to kind of reposition their funds.
Yeah, definitely. And you mentioned at the beginning of the show that there is a reduction in cost, and also you make the market more efficient by doing this through DeFi. So could you give us a little bit more concrete example of the reduction in cost? What are the fees we are managing here?
Yeah, so with a DeFi application, the value here is that these builders have created essentially code that takes the place of what an individual would have to do in the traditional system. So in the traditional system, you would have an investment banker that would actually look over the loan that they're providing, justify, make sure that the investor is somebody who they say they are, do all the compliance things that we said. Also from the other side, making sure that the assets are changed and change hands, right? They may come from one bank to another bank. There's a lot of different systems there. So you have to pay not only that individual to do that for every single transaction, but you also would have to pay all of those bank-to-bank fees. You have to pay all the different financial service providers that are involved in that process. And there would be that time where they would actually have to review each application, give credit scores, all those different pieces. In DeFi, the cool thing is that they've really pioneered over-collateralized loans. And so what an cash flow. So I need to put up, let's say, 125% of the amount of the asset that I am taking from a loan, or I'm getting in cash, for the crypto or asset that I'm staking. And so because of that, if I choose to default, if I choose not to pay back my loan, the application actually makes a profit on that because I gave up more than what I was getting. So there's no risk to the platform to give me this opportunity because I'm staking more than what I'm getting. And so that's kind of how they help to mitigate that risk, and it reduces the cost because it's code that we've developed that it says as long as you put in this, you're able to get this, make it happen. That's kind of all that it is. And then obviously you may need to build other pieces on top of that when we start to talk about real world assets, as we mentioned, because there's an additional layer of compliance that needs to happen. But if you think about it, instead of needing to have somebody that manually checks for all these different pieces, you could just have a program that says, okay, are they a citizen of these approved countries? Are they qualified to make this investment? Do they have the specific asset that they say? Do we have the reserve pool of the asset that they want? And if all of those things are checked off, it should just happen. Like, we don't need to have somebody that manually checks those things off if we can just approve it. And so that's kind of where the future of this stuff is going. And again, as you can see, just in that example, you can have a significantly higher amount of loans actually being given out because you don't need a manual approval every time. And as long as we're keeping it as an over-collateralization model, there's much less risk of default because this person has already put up assets that are more valuable, and provided that those assets are liquid enough, which is its own maybe conversation, but provided that those assets are liquid enough to be able to convert that back into the collateralized cash or whatever the asset that you gave out were, there's not much risk to the system, and therefore, you know, they can give very favorable rates. They don't need to charge really high rates to the lenders or to the lendees. You know, in a traditional bank, they would have to charge, you know, an arm and a leg in order to give you this loan because it's risky for them. But if you've already put up all this collateral, it's much less risky, and therefore you don't have to get charged as much for your loan, which is another way that you bring those expenses down.
Yeah, absolutely, absolutely. And maybe the last or second last question is regarding the liquidity in these protocols. Who is pumping money in here and who is on the other side of the equation? So who is giving these loans to these people that have the collateral, the tokens, and want to extract liquidity?
So there's this idea of it's a term called total value locked. And this is a term that often is used to evaluate the health of a DeFi application. The idea with TVL, or total value locked, is that we're looking at how many people have decided to stake their assets into the protocol. And so with, you know, there's a lot of people that are placing their assets in the protocol in exchange for getting an interest rate on that. So they may not themselves pull out collateral. They may just be putting in the asset that they have, which is then used as a collateral for others. And so they can get some of that return that we're talking about in that lending model. As the DeFi protocol lends out cash to somebody else, the rate that it's making on that is then given to the people that stake their assets into the underlying liquidity pool. So the protocol itself isn't actually taking any of that profit. It's actually being distributed on the other side to the people that are actually pumping it full of liquidity, which is a very interesting model. That would be called staking and staking rewards if somebody was interested in looking more into that. But essentially, you've got two sides. You've got somebody that wants to get a loan, and then you've got people that are putting up the underlying backing collateral. This person also needs to put in capital in order to get capital, but the underlying people provide that base so that they can continue to give out all of that liquid cash. And then in exchange, those people get paid back the interest on the loan that the person pays back over time.
Yeah, it's amazing how we are evolving here, and that everything is run through a smart contract and goes, no? Because if you have told someone 10 years ago or 5 years ago that it was possible, maybe he would thought that you are crazy. So yeah, I mean, I'm amazed by these things and how things are evolving, and they are evolving, I think, in the right way. And as you said before, like, regulation is also being more friendly and looking at this with good eyes, which is good for the ecosystem. So yeah, and maybe last question, something that is also in the mouth of a lot of people right now is, okay, DeFi, you mentioned there's Aave, Compound, Uniswap, there are different protocols, but then do you think that in the future we are gonna see a DeFi protocol for real estate assets, DeFi protocol for US equities or US token shares, and another one for European token shares? Do you see this fragmentation or is gonna be everything in the same protocol?
I've actually been preaching interoperability. Interoperability is this idea that we can all work together. I don't think that fragmentation is the right strategy, but when we think about it just from a logical perspective, the tokenization piece is taking all of these real world physical assets and creating a standardized blockchain-based token. And that's what the smart contracts operate on. The smart contracts don't care whether it's a real estate property or an equity. We've created a blockchain-based token, and so those things can move in the exact same way. We obviously need to establish the compliance layer, which is going to be very important, but provided that those compliance pieces and regulatory complexities are encoded into your individual wallet and into the individual asset, the smart contracts themselves don't care what kind of asset it is, which is great for investors because you can buy all these things from the same platform. You can get exposure from a lending perspective using all these different assets. There should be no reason why it's European focused versus US focused versus real estate versus private equities versus public equities. All these things can all work together. certainly I think at first you're going to see it more likely starts fragmented because of the compliance piece, right? If you're an expert in real estate, you might just want to focus on real estate to prove the concept. But I think in the future and where we're headed is that all these things can work together and be optimized in that same process. There's no reason why this same technology that we're working on and what we've seen from the crypto space can't apply to any of those different assets, real estate, equities, X, Y, and Z. And the power is in the liquidity of the system. So making sure that they all work together only makes it more effective, more cheap, better rates. All those different things are compounded the more assets we have, all pulled together. So I really do see a future where all this stuff works together, which is really the promise of security tokens, is creating a global financial system here, having investors be able to buy and sell US real estate from anywhere around the world, or for US investors to be able to invest in emerging tech companies in Africa or whatever. Anyone being able to buy and invest in companies and assets around the world and then be able to trade them with each other, in those kinds of places, I think is something that is absolutely going to happen in the future, and a future that I believe in and I'm happy to be building in.
Yeah, absolutely. I completely agree with you. I think the most assets or the more tokens we have in a platform or in a protocol, the better, because you are focusing all the attention, all the liquidity in one space. So rather than having different platforms, then you have everything together. So you give more liquidity and more opportunities to investors and people listing the tokens there. So yeah, and in the interest of time, I'm gonna take the bonus question. So sorry for that, but I think it's a spicy question. So
cool.
I wanna see your reaction and your answer on this. Where do you see traditional banks in all of this?
That's a fantastic question. They're not going away. They definitely can't go away, at least anytime soon. Certainly a lot of their services are going to need to evolve, but the network effects that the traditional banks have and the influence that they have on the traditional financial markets is something that we certainly have to accept and work with, because of the fact that we're working with compliant assets here. We're talking about real world assets, and we need their ability to underwrite deals. For example, they've got huge stacks of cash, and when we're talking about underwriting, right, they subscribe a deal so that an issuer knows that they've got their cash committed. Underwriting is something that's super important and that we don't see from traditional brokers today. And so I think that from an investment bank perspective, a lot of their broker services and underwriting services are still going to be so incredibly valuable in the future of all this stuff. They're also, have a lot of expertise on the regulatory complexities of making complex financial and synthetic vehicles, which will be very valuable in building smart contract logic that works with all the different financial service providers and all those different pieces. The value of these investment banks is that they have such a broad range of services that they can really create a strong ecosystem throughout each of those different pieces that isn't quite as fluid when you have a lot of different small startups that are building their own tech, right? It can be a little bit clunky sometimes, as opposed to the Goldman Sachs method, which might be very fluid because it's all through their services. So I definitely don't think that they're going away, but they will need to adjust, because their current business model of just employing a ton of people and just hounding people at it is not a scalable solution, and I don't think it takes full advantage of the opportunity of blockchain.
Okay, so it was a good answer. So yeah, thank you very much for your time, Kyle. And for those of you that want to learn more about tokenization, please pay a visit to his channel. Is the Security Token Show, right? He has already done many episodes and he explained basically everything there. I already saw some videos and they are amazing. So for those of you more interested in the topic, please visit the YouTube channel. Thank you very much, everyone that is watching this video, and see you in the next episode for the Tokenizer by Crypto Valley Association.
Thank you so much. Appreciate it, man.
Thank you.